The biggest expense in the system right now isn't growth, it's interest. Today, we're breaking down how debt moves through the markets, shapes the economy, and ultimately impacts your financial life. I'm Christiana Lovelace. I'm a licensed financial advisor, an accredited asset management specialist, and the owner of Diamond Point Financial. Each week on Pointe Perspective, we step inside the analytical process behind financial decision making, breaking down how professional investors interpret the system and build strategies designed to move with it. This week, we're focusing on one of the most influential forces in that system, that is debt. First, we'll break down how leverage works in the markets, how it's used, and why it can amplify both gains and losses, especially in today's environment. Second, we'll walk through how government debt is created, how it's managed, and how rising interest costs are starting to influence policy decisions and economic flexibility. And lastly, we'll take a look at how debt can affect retirement, the risks it can create, and how to think about it more strategically over time. It's easy to assume that your debt is the only thing that matters, but debt doesn't just exist in one part of the system. It moves through all of it. And when you understand how those pieces connect, you start to see how it's really impacting your financial life. Over the last few weeks, we've been talking about volatility and how different parts of the market respond to changes in interest rates, economic conditions, and uncertainty. But there's another layer to that conversation that doesn't always get discussed. Debt actively influences how quickly things move. It can accelerate gains when conditions are favorable, but it can also amplify losses when the environment shifts. That becomes especially important in periods like the one we're in now, where rates are higher, capital is more expensive, and expectations are elevated. When we talk about debt in the market, we're typically referring to leverage. Leverage is the use of borrowed money to increase investment exposure. One of the most common examples is a margin account, where an investor can borrow against their portfolio to purchase additional securities. That can increase returns in a rising market because you're earning on a larger base of capital, but losses are calculated the same way. If the market declines, those losses apply to the full position, not just your original investment. And because that borrowed money must be maintained, it introduces additional risk. If the value of the account falls below certain levels, it can trigger a margin call, requiring the investor to deposit additional funds or sell holdings in order to meet minimum equity requirements. If those requirements are not met, positions can be liquidated by the broker, often at a loss and without prior notice. This becomes more relevant in today's environment. With higher interest rates, the cost of borrowing has increased, which changes the entire risk versus return equation for leverage. It's no longer just about market direction. It's about whether the potential return justifies the cost of the debt. At the same time, we're seeing more dispersion across the market. Some sectors are performing well, while others are more volatile, which increases the likelihood of short-term declines. And when leverage is involved, those short-term moves can have a much larger impact. Keep in mind, leverage is used across the market, from individual investors to hedge funds to public companies, so its effects can show up at multiple levels. We're seeing a version of this dynamic play out right now with artificial intelligence. There's a significant amount of capital being invested into AI infrastructure, data centers, and development. Some of the largest companies in the market are funding that growth from a position of strength. They have strong balance sheets and consistent cash flow. But not every company is in that position. In environments like this, a gap starts to form. Some companies can fund growth internally, while others may rely more heavily on debt or external capital to keep up. And if those investments deliver, that leverage can accelerate growth and returns. But if expectations don't materialize as quickly, or if the cost of the capital remains elevated as it has, that same debt can begin to pressure margins, earnings, and valuations. The opportunity may be real, but the difference is how it's financed. This is part of the reason we can see sharper moves in certain areas of the market. When expectations are high and capital is heavily invested, the margin for error becomes smaller. And when leverage is involved, that can create a destructive loop, where declines lead to selling, and selling accelerates declines. So while debt doesn't determine the direction of the market, it does play a significant role in how that movement unfolds. It doesn't create outcomes, but it does amplify them. Last week, we talked about how money moves through the system, particularly through banks and lending. This week, we're expanding that conversation to look at government debt, Debt plays a central role in how the overall economy functions. Just like your own household finances, government debt is created when spending exceeds revenue. When the government spends more than it collects in taxes, it finances that gap by issuing debt, primarily through Treasury securities like bills, notes, and bonds. Investors, institutions, and foreign governments purchase that debt, effectively lending money to the government in exchange for interest payments. So in the same way that you pay interest on a loan, the government pays interest to the holders of those products. Now, that process doesn't happen randomly. The U.S. Treasury is responsible for issuing that debt, managing how much is borrowed, the structure of that borrowing, and the timing of when it's issued. They work to balance short-term funding needs with longer-term obligations while also responding to market demand and interest rate conditions. There's an active management process behind how that debt is structured, not just how much exists. To put this into perspective, the U.S. government debt has grown to over $34 trillion. And one of the key shifts we're seeing right now isn't just the size of that debt, it's the cost of servicing it. With interest rates higher than they've been in recent years, the government is now paying significantly more in interest expenses, which has become a meaningful portion of the overall federal spending. In practical terms, that means a larger share of tax revenue is going toward interest payments rather than other areas of spending. This is where it starts to affect the broader economy. Higher levels of debt combined with higher interest rates can influence policy decisions, fiscal flexibility, and long-term economic growth. As more resources are directed towards servicing debt, there's less flexibility for other areas of spending without increasing borrowing further. As an example, that can resemble situations at your own household level, where new borrowing is used to manage existing obligations, but this is on a much larger and more complex scale. This also ties back to what we've been discussing with the Federal Reserve. The Fed manages inflation and economic activity through interest rates and liquidity, but like everything else we've discussed, those decisions don't happen in isolation. Higher rates can slow inflation, but they also increase the cost of borrowing across the system, including the government's own debt. So there's a balance that has to be maintained between managing inflation, supporting growth, and maintaining overall stability. Similar to the markets, debt at the government level doesn't determine the direction of the economy, but it does play a significant role in how that environment develops over time. It continues to influence interest rates, spending, and long-term policy decisions. When most people think about retirement, they focus on income, investments, and how much they've saved. But debt is one of the biggest factors that can impact your retirement. Debt doesn't disappear when you stop working, and if you've relied on debt during your working years, that pattern is likely to continue into retirement. And with income more limited, that can come at a significant cost to your plan. We're actually seeing this more and more. A growing percentage of retirees are entering retirement with existing debt, whether that's mortgages, credit cards, or other obligations. A significant portion of households over the age of 65 still carry mortgage debt, and credit card balances among retirees have been increasing over time. Bankruptcy rates among older Americans have also risen compared to previous decades. As of 2024, nearly half of new filers were age 50 or older, and filings among those 65 and older have increased significantly over the last 2 decades. So this isn't a small issue, it's becoming a trend. The challenge is that debt behaves differently once you're in retirement. During your working years, income is typically more flexible. You might be able to earn more, adjust, or recover from financial pressure. But in retirement, income is often more fixed, which means debt payments don't just reduce cash flow, they compete directly with your ability to cover essential expenses and maintain your lifestyle. That being said, not all debt is inherently bad. There are situations where certain types of debt, particularly low interest debt, can be managed strategically. For example, it used to be widely assumed that mortgages should be paid off before retirement. And in some cases, especially when interest rates are higher, that may still make sense. But in other situations, individuals may choose to maintain a mortgage into retirement, particularly if the interest rate is low and their investments are structured in a way that could support that cost over time. That decision depends on the full financial picture. You need to analyze your cash flow, your risk tolerance, and how the overall plan is structured. I often have clients ask whether they should withdraw funds from their retirement accounts to pay off their mortgage. And while that may be an appropriate strategy for some cases, we also evaluate whether the portfolio can support the ongoing payments while allowing the remaining assets to stay invested. For example, if a mortgage rate is around 4% and a portfolio is generating a higher long-term return, withdrawing a lump sum could reduce the potential growth of that portfolio. So in some situations, we can structure distributions to cover the mortgage payment, which may help manage their monthly cash flow while also allowing the broader investment strategy to remain intact. It's important to keep in mind that this is simply an example, it's not a guarantee, and every situation should be evaluated individually. When we look at debt in retirement, the question isn't just whether you have it, it's what role does it play? Does it create pressure on your plan, or does it fit within it? From a planning standpoint, reducing high-interest debt before retirement is often an important goal. For many individuals, working to minimize or eliminate revolving debt, like credit cards, can significantly improve financial flexibility later in life, and in some cases support more sustainable spending habits as they transition into retirement. Understanding the cost of your obligations and aligning those decisions with your overall income strategy can make a meaningful difference in long-term outcomes. At the end of the day, debt in retirement is either a constraint or it's a tool. The difference comes down to how it's managed within your plan. Today, we looked at how debt shows up across the entire system. When you step back and look at all of it together, you realize that debt exists at every level. You see it in the markets, you see it in the economy, and you see it in your own financial life. And while you can't control how it moves through the entire system, you can control how it shows up in your own financial plan. Next week, we're continuing this discussion on debt. We'll look at how the value of debt changes based on interest rates. We'll break down the difference between deficits and debt at the government level, and we'll begin shifting focus more directly to your financial life, starting the conversation around what is considered good debt and what is considered bad debt, and how to think of both of them more strategically. If you found this discussion helpful, make sure you subscribe to the channel for new discussions every Thursday. For a summary of each episode, you can subscribe to our weekly newsletter, which is sent out every Friday. And if you have questions about your own financial situation, you can learn more about Diamond Point Financial using the information below. I hope this offered some useful perspective. Until next week, take care.